Same markets, same charts, same 24 hours in the day. So why is one trader compounding a small account into a real living while you're still sitting at break even after 2 years of trying? I'm not going to tell you it's discipline. I'm not going to tell you it's risk management. Every video on this topic tells you that, and if it actually worked, you wouldn't be watching another one right now. You'd already be profitable. Today, I'm going to show you the 3 real reasons you're still not profitable. And I promise you, none of them are what you think they are. One of them is going to make you uncomfortable because it's going to sound like I'm accusing you of something. I am. Stay with me anyway. You are smart, you've read the books, you've watched the webinars, you've back-tested, you've journaled your trades, some of you for years, and you're still not there. That should tell you something important. The thing standing between you and profitability was never information. You have more information than 99% of professional traders had access to 30 years ago. It's not that. It's not intelligence. It's not capital. It's not access. Everyone watching this has a laptop with more analytical power than an entire Wall Street trading floor had in 1985. The difference is somewhere else entirely. And most trading education refuses to go there because it's not comfortable and it doesn't sell courses as easily as, here's my 12-indicator strategy. Let me tell you about 2 traders. I'll call them David and Sarah, though I've changed enough details that you won't recognize either of them. What matters is the shape of their stories, because you've probably lived one of them already. David is an engineer, mechanical, sharp, exactly the kind of mind you'd assume would crush trading. He built a spreadsheet that tracked 41 variables before he'd even take a trade. RSI divergence, volume profile, 3 different moving average clusters, a custom volatility filter he coded himself, correlation with the dollar index, even a sentiment score he pulled from scraping forum posts. He was, by any measure, one of the most prepared retail traders you could imagine. He blew through his account in 14 months, then a second account, then a third. Each time he told himself the same story. The system almost worked, he just needed to add one more filter. One more piece of confirmation, one more layer of certainty before he pulled the trigger. Sarah was a dental hygienist. She had 0 background in markets. She took 1 basic course, wrote down 4 rules on an index card, and taped it above her monitor. She still has that index card. 4 rules. Not 41 variables. 4. 18 months later, Sarah was pulling a modest but real second income from trading. Not life-changing money, consistent money. The kind that compounds quietly while nobody's watching. Here's the part that should bother you. David was smarter than Sarah. He worked harder than Sarah. He wanted it more than Sarah, in the sense that he obsessed over it, stayed up analyzing charts until 2 a.m., read more books than she ever will. And he still lost, while she quietly won. Not because she was smarter, because the actual game she was playing was completely different from the game David thought he was playing. That's the whole video, right there. Most of you are playing the wrong game extremely well. Let's break down exactly what that means, because there are 3 specific and very real reasons this keeps happening, and I want you to check yourself honestly against each one. Reason number 1, you are not trading for money. You are trading for a feeling, and the feeling is the thing sabotaging you. I need you to actually sit with this instead of dismissing it, because it's the one most people scroll past. Ask yourself honestly, what does it feel like in your body right before you enter a trade you weren't planning on taking? For most struggling traders, there's a specific sensation, a tightness, an urgency, almost like an itch that needs scratching. That sensation isn't analysis. That's a chemical event, and your brain produced it on purpose. Here's what's actually happening. Every time you open a position, especially an impulsive one, your brain releases dopamine not from winning, but from the anticipation of an uncertain outcome. This is the exact same mechanism that makes slot machines addictive. Variable, unpredictable rewards produce a stronger dopamine response than reliable, predictable ones. A slot machine that paid out every single time you pulled the lever would be boring. A slot machine that pays out unpredictably is the most addictive machine ever built by human hands. And trading, structurally, is that machine. This means your brain doesn't actually want you to be profitable. Profitability requires fewer trades, tighter rules, more boredom, more waiting. Your brain wants more trades because more trades means more anticipation events, means more dopamine, means more of that itch getting scratched. You are not fighting a lack of discipline. You are fighting a reward system that is working exactly as evolution designed it to work, just aimed at the wrong target. This is why traders revenge trade after a loss. It's not really about making the money back, even though that's the story people tell themselves. It's about needing another hit of that anticipation feeling to counteract the crash that follows a loss. It's why traders who are already up a healthy amount for the month keep trading anyway, when the smartest move would be to stop. Stopping ends the anticipation cycle. Continuing feeds it. David, the engineer from earlier, wasn't adding 41 variables to his spreadsheet because he genuinely believed variable 42 would be the missing piece. He was adding them because building the system gave him the same dopamine hit that taking the trade did. Research and overanalysis can become their own addictive loop, completely separate from whether they improve results. He was, in a very real sense, addicted to the process of almost being ready, because being ready and pulling the trigger meant facing the terrifying uncertainty of an actual open position. The 95% treat trading like entertainment wearing a business suit. The 5% have made trading so boring that their brains stopped rewarding them for it, and that's exactly why it works. Reason number 2, and this is the one almost nobody talks about, because it requires admitting you've been solving the wrong problem entirely. You think trading is a prediction problem. It is not. It is an exposure and inventory management problem, and as long as you keep treating it as the first thing, you will never fix it by getting better at the second. Think about what a casino actually does. A casino has no idea what number is going to come up on the roulette wheel next. None. They are not in the prediction business at all. What they are in is the exposure business. They know that across enough spins, the house edge plays out, and their entire operation is built around managing how much exposure they have at any one moment, so that a bad run of spins never threatens the business itself. The wheel is genuinely unpredictable. The business is genuinely, reliably profitable. Those two facts coexist because the casino separated prediction from survival. Most retail traders have never separated those two things. Every decision they make is oriented around what will price do next, when the actual professional question is, how much am I exposed to being wrong, and can I survive being wrong here? Notice those are completely different questions. One is about the future. One is about the present. One is unanswerable with certainty. One is completely within your control right now before you click buy. This is why position sizing gets treated as a footnote in most trading education, some afterthought you slot in after you've picked your real strategy, when it should be the entire strategy. The entry is honestly the least important decision you'll make in a trade. It's the one everyone obsesses over anyway, because it feels like the prediction part, the exciting part, the part that lets you be right or wrong about the market. Exposure management doesn't feel exciting. It feels like paperwork. It is also the only part of the process a professional actually controls. Here's a specific, concrete way this shows up. A struggling trader sees a setup they like and sizes it based on how confident they feel. High confidence, bigger size. Low confidence, smaller size. Or they skip it. That confidence is not measuring anything real about the market. It's measuring an internal emotional state, usually inflated by a recent winning streak or deflated by a recent losing one. A professional sizes every position based on a fixed percentage of account risk, calculated the same exact way regardless of how they feel about the trade. The trade that feels like a sure thing gets exactly the same risk allocation as the trade that feels shaky. Feelings are not inputs. They're noise wearing a suit and tie. This is also why the exact same setup, the exact same entry signal, produces a blown account for one trader and a stable account for another. It was never really about the signal. The signal was almost identical for both of them. What differed was how much of the business they put at risk on any single roll of the wheel. David was searching for a signal precise enough that he'd never need to worry about exposure, because if he could just predict correctly enough, sizing wouldn't matter. That system does not exist, and never will, because markets are fundamentally, structurally uncertain at the time frame most retail traders operate on. Sarah never tried to build one. She accepted the uncertainty as a fixed cost of doing business and built her entire four-rule system around surviving being wrong far more often than being right. There's a specific test you can run on yourself right now to see how deep this goes. Pull up your last 20 trades. Not the winners you remember fondly, all 20. For each one, ask yourself, did I size this based on a fixed rule I decided on before I saw the setup? Or did I size it based on how the setup made me feel in the moment? Most struggling traders discover something uncomfortable when they do this honestly. Their biggest losses weren't on their worst setups. Their biggest losses were on the setups that felt the most obvious, the most certain, the ones where they sized up because this one couldn't lose. Certainty is a feeling. It has never once been a property of the market itself. The market doesn't know how certain you feel, and it has never once adjusted its behavior to reward your confidence. This is also why professional risk desks at large funds have a rule that sounds almost insulting to a retail trader's ego. No single position, no matter how good it looks, is allowed to threaten the survival of the fund. Not because the fund lacks conviction, because conviction is not a risk management tool. And the professionals who last decades in this business are the ones who accepted that fact early, while the ones who flame out are almost always the ones who let a sure thing carry more weight than their own rules allowed. Reason number 3, and this is genuinely the one I think matters most, even though it's the least talked about. Your trading system, whatever it is, cannot fail. And a system that cannot fail cannot teach you anything, which means you have been unable to actually learn from your last 2 years of trading, no matter how many trades you've logged. Let me explain exactly what I mean because this sounds strange until you see it in action. A good system, a scientific one, makes a clear prediction in advance, and there is some outcome that would prove the prediction wrong. That's what makes it useful. It can be falsified. A bad system, the kind most struggling traders unknowingly build, has so much flexibility built into it that literally any outcome can be explained after the fact as consistent with the system. Win or lose, the story afterward always fits. Here's what that looks like in practice. A trader takes a long position because of a bullish flag pattern. Price falls instead. Rather than treat this as the pattern failing, they say the flag was invalidated by a news event, or that they should have waited for confirmation on a lower time frame, or that the overall market context wasn't accounted for. None of that is wrong exactly, but notice what just happened. The system was never tested. The explanation absorbed the failure, and the belief in the system survived completely intact. This can happen every single time a trade goes wrong, forever, without the trader ever once discovering that their edge doesn't actually exist. This is precisely what David was doing with his 41 variables. Every loss had an explanation that added complexity rather than subtracting confidence. The system almost worked. It just needed one more filter. That sentence is the sound of a system that can never be falsified, being protected from the one thing that could actually improve it, which is being proven wrong in a specific learnable way. Sarah's 4 rules worked precisely because they were simple enough to actually be wrong. If price didn't do what her rule predicted, there was no room to explain it away. The rule failed. She could count exactly how often it failed across enough trades to know her real numbers and build her sizing and expectations around those real numbers instead of a story. Her system was allowed to be wrong in public, to itself, in a way that David's never was. This is the version of trading education nobody sells you a course on, because make your system falsifiable doesn't sound as exciting as master this profitable setup. But it's the actual mechanism by which professional traders improve over time, and struggling traders stay stuck in the exact same place for years. You cannot learn from 200 trades if all 200 of them can be explained away after the fact. You've done the work of logging them. You haven't done the work of letting any of them actually be wrong. So here are the 3 shifts, and I want to be specific, not motivational, because vague advice is exactly what got you here in the first place. Shift 1, directly targeting the dopamine problem. Set a hard cap on trades per day or per week, low enough that it feels almost uncomfortably restrictive, and treat hitting that cap as a rule, with 0 exceptions. the same way you'd treat a stop loss. The goal isn't discipline for its own sake. The goal is starving the anticipation loop of fuel until your brain stops treating trading as a slot machine and starts treating it as a low-stimulation task, which is exactly what it needs to become. One trader, I'll call Michael, cut himself from an average of 11 trades a day down to 2. His win rate didn't actually change much. His account did because he removed almost every trade that was fueled by the itch instead of by the setup. Shift 2. Targeting the exposure problem directly. Before you ever look at a chart for entry signals, decide your risk per trade as a fixed percentage, something small, often 1% or less of your account, and calculate your position size from that number every single time, with zero adjustment for how confident you feel. Make the position sizing math the very first thing you do, not the last. If a trade doesn't fit inside that pre-decided risk number, the size gets smaller. It never gets bigger because you like the setup more. Confidence is not a variable in the equation, ever. Shift 3. Targeting the unfalsifiable system problem. Write your trading rules down in a form specific enough that you could hand them to a stranger and they'd take the exact same trades you would, with no room for interpretation, no use your judgment here, no vague language. Then, every time a trade doesn't work, force yourself to write one sentence describing exactly what would need to be true for you to conclude the rule itself is wrong, not just this instance of it. If you can't write that sentence, your system isn't falsifiable yet, and no amount of trading it will teach you anything real. Here's where this stops being about tactics and becomes about identity, because that's actually the level this problem lives at. Right now, many of you think of yourselves as traders who are searching for the right system. That search itself is the problem, because it keeps you oriented toward finding something external that will finally make you right more often. The actual shift, the one that changes everything downstream of it, is becoming someone who manages exposure to uncertainty, rather than someone who predicts outcomes. When you stop being a predictor and become a risk manager, profitability follows naturally, almost boringly, because you've stopped fighting the actual structure of markets and started working with it. And I want to be direct about something most trading content won't tell you, because it's bad for engagement. Trading, done correctly, is not exciting. It should not give you the same feeling as the first 6 months of learning it did. If you are still getting a rush from your trades, you have not yet made the shift, no matter how good your win rate looks on a given week. Professional risk managers at hedge funds describe their day-to-day work as closer to accounting than to gambling. The excitement is gone, and its absence is the actual signal that something real has changed. If trading still feels exciting to you, that excitement is the dopamine loop from reason number 1, still running quietly in the background, still steering decisions you think are purely analytical. Boredom isn't the price you pay for mastery. Boredom is what mastery actually feels like, from the inside, once you get there. Think about any skill you've actually mastered in your life already. Something completely outside of trading. Driving a car, the first few weeks were tense. Your hands were tight on the wheel. Every lane change felt like a decision. Years later, you drive to work without remembering most of the trip. That's not because you stopped caring about driving safely. It's because the skill became structural, embedded, no longer requiring the emotional charge it once did. Trading is supposed to end up in exactly that place. Boring, structural, barely memorable day to day. The traders still describing their trading as thrilling after 2 or 3 years are, in a very real sense, still learning to drive with white knuckles, no matter how much technical knowledge they've stacked on top of that unresolved emotional charge. David, the engineer, eventually did something almost nobody does. After his third blown account, he stopped adding variables and started subtracting them. He cut his 41 down to 5, then eventually 3. He wrote a rule specific enough that a stranger could execute it exactly as he would. He calculated his position size before he ever looked for a setup, every single time, with no exceptions for confidence. It took him almost a year longer than it took Sarah, because he had a lot more to unlearn than she ever had to learn. But he got there. Last I heard, his account was quietly, boringly, consistently green, month after month, and he described the work itself in his own words, as genuinely dull, which is exactly what it should sound like when it's finally working. Sarah is still trading her 4 rules. She added a 5th. Eventually, after enough falsified failures taught her something real about her own edge. She still has that index card taped above her monitor. So here's the actual choice in front of you, and it's a binary 1, not a spectrum. You can keep chasing the anticipation feeling, keep obsessing over prediction instead of exposure, keep building a system flexible enough to never technically be wrong. That's the 95% path, and you already know exactly where it ends, because you've been living some version of it for however long you've been trading. Or you can starve the dopamine loop, put exposure management ahead of every entry decision, and build rules specific enough to fail, so that they can finally teach you something true.